Hello, I'm Shaun Robson,
And I'm Will Stevens.
and we're here today to discuss the upcoming budget from the new Labour government and the impact that may have on young professionals and young families. Will, perhaps you could give us a little understanding of those young families and young professionals and the impact that they might want to be considering in terms of what changes may be coming in the budget?
Yeah, absolutely. So if I take a look at some of the clients that I work with on a regular basis, I'm working with young families, young professionals who are looking to save and invest for their future, who are perhaps early in that journey in terms of building wealth for the future for them and their family. And a lot of the conversations I have with them are about how do they balance the need to save and invest for themselves so they can fund their retirement down the line versus other ambitions that they might have, whether that's purchasing a property, upsizing, or potentially even paying for private education for their children. And really the challenges for them come in terms of how do you weigh all of those up together? What do you need to think about in terms of where are you saving? How much are you saving? Can you afford to be saving versus the expenses you've got? And a lot of these families have been impacted obviously by increasing costs of living, mortgage rates, which have been on the rise for the last few years, and now potentially the prospect of tax increases or certainly a reduction in tax reliefs that are available to them.
Yeah. So clearly there's lots of competing interests for young families, young professionals when they're trying to balance saving and the ongoing costs that as we've seen increasing. Is there anything that you think they are most concerned about when it comes to the upcoming budget and any particular changes they want to be looking out for and maybe planning ahead of?
So I think we've had a big one already, which is they've announced VAT on school fees, and we have talked about that in previous videos. But that's potentially putting further pressure on the regular outgoings for a family. So there are individuals who are concerned, can they afford to meet those costs on a regular basis? It's quite a significant commitment. But beyond that, for those who are in a position to be saving for the future, then there's a bit more concern, I would say, around what allowances are going to be available to them, how much tax relief might they be receiving, and what is that picture going to look like when they actually get to the point of retirement and are able to begin drawing on those funds. So just to reference, I guess, a few of the key topics that we've been picking out in the conversations I'm having with clients, one of the big ones has been pension tax relief on the contributions that are made into the pensions. How much that annual allowance is. Can they continue to put away, as it stands today, up to £60,000 a year? Well, that may well come down. And for those who are higher and additional rate taxpayers, are they going to be in a position to continue to get the tax relief they've been accustomed to, which has been at their marginal rate historically? There's been discussion, particularly in the newspapers, around a flat rate of pension tax relief, which would obviously negatively impact on those individuals, positively impact on basic rate taxpayers. So there's a balance there in terms of the impact as a whole.
Okay, in terms of pension savings, we heard from the government pre-election in terms of their manifesto and a commitment that they weren't going to make any changes to pension legislation this year to try and create some certainty in the pension system, and confirmation from the party that they weren't going to look at things like tax-free cash. But actually, is there anything that these young professionals and young families could do ahead of the budget just in case there are any unexpected changes to pensions regime post-budget?
The key things to be thinking about are utilising what you have in front of you now while you know what it is, whilst we know the current position as it stands. So we know what tax relief is available today, and we hope that will continue for the rest of this tax year as a minimum. That is our expectation. And we know what the contribution allowances are today, and so it's about making use of those if you can, and trying to work within the understanding of the rules as they sit today. We don't have a crystal ball. We can't gaze into the future about what it might look like next year, even 5 years down the line. But what we can say is what the position is today, and we can advise based on that position today. So if you are fortunately in a position where you can afford to put money away for the future, it's about knowing, do you put that into an ISA contribution allowance, which is £20,000 per year per person at the moment? Or do you put that money into a pension whilst the threshold and the amount that you could put in is that much higher? So that's, as I mentioned, up to £60,000 per year currently. There is also the ability to carry forward previous year's unused allowances. And so for those who perhaps haven't fully utilised their pensions allowances historically, they might be in a position to benefit from some additional tax relief now if they've got funds available to put into it. But we recognise that that's not for everyone, and that other people maybe don't have as much of a surplus. For those individuals, I think a really key point is to understand what does the financial position look like now, and what will it look like if you make certain decisions moving forward. So this is where engaging with an advisor can be really helpful in terms of modelling that, and something that we do with a lot of clients in terms of cash flow modelling future scenarios based on saving different amounts or making different choices.
It's quite clear that there's lots of decisions perhaps for young professionals and young families to consider in the run up to the budget, and we would, as Will mentioned, recommend for those that are uncertain about the way they should navigate those changes to seek advice from your advisor and try and create some certainty, as Will said, with the use of cash flow forecasting and helping you make those decisions that are aligned with meeting your objectives. Thank you very much, Will, and as ever, if you have any questions, please do get in touch with us today.